You've probably heard before that using an ETF is a safe, passive way to invest. But few people know that there are different kinds of ETFs specific for the AI sector, and choosing the right one could be your high velocity engine to fund your biggest life purchases. Honestly, with $15 trillion expected to hit the global economy by 2030, you don't need to be a genius, you just need to ride the right vehicle. In this episode, we're going deep into the human body of the AI ecosystem. We're breaking down the brains, the software, and specifically the hands and feet of the industry. We'll discuss and compare different kinds of AI ETFs. The robotic space will put the two biggest heavyweights, BOTZ and ROBO, head to head so you can decide which meets your risk profile. So, what do you say we stop spending money and start deploying it effectively to buy the things you really want in life? Let's get into the mechanics.
Imagine you have $45,000 just sitting in your checking account right now.
Okay, a pretty nice scenario to start with.
Right. And your absolute dream, like the thing you want more than anything, is to buy a Tesla Model 3.
Ah, great car.
Yeah. And you have the cash. I mean, you could literally walk into the dealership this afternoon, sign the paperwork, and drive it right off the lot.
But there is a catch, obviously.
A massive catch. The second you do that, your account balance drops to absolute zero.
Right.
That financial cushion you worked so incredibly hard to build is just gone. But what if there was a way to buy that exact car without ever actually touching your original $45,000?
I mean, I know it sounds like a late night infomercial pitch, right? But it is actually a mathematical reality. It just requires fundamentally changing how you think about your capital.
How so?
Well, instead of treating money as something you just, spend, you have to treat it as an employee. And you need to put that employee to work in an industry with enough momentum to actually generate the purchase price of that car for you.
And right now, the greatest engine for that kind of momentum is arguably artificial intelligence.
Oh, absolutely. Without a doubt.
I mean, we are looking at a projected $15 trillion being added to the global economy by 2030 because of AI.
It's a staggering number.
It really is. And today's deep dive is custom tailored for you, the listener, who sees that massive shift happening and, wants to capture a slice of that pie, but maybe feels just totally overwhelmed by the sheer volume of options.
Because there are a lot of options out there.
So many. So we are going to unpack how different AI exchange-traded funds, or ETFs, offer completely different timelines and risk profiles for growing your capital. We'll be looking under the hood of the top funds on the market right now to give you those hard-to-find details the headlines usually just skip right over.
But before we get into the actual mechanics of these funds, we really have to lay down the mandatory ground rules.
Oh, right, the legal stuff. Go for it.
Yeah. This deep dive is strictly for informational and educational purposes only. It is not financial advice. Investing carries inherent risks. Markets are volatile, and you should always do your own due diligence before making any investment decisions.
Perfectly said.
Our goal today is simply to analyze the data and the underlying machinery of these funds so you can understand how they actually behave in the wild.
Okay, let's unpack this. Because when people think about getting into the AI boom, the temptation is always to try and find that one miracle stock, right?
Right. Everybody wants to find the next Amazon or the next Apple.
Exactly. But trying to guess which individual AI company is going to be the massive winner is terrifyingly risky. I mean, if you guess wrong, or if, say, a CEO makes one really bad decision, you could lose a massive chunk of your savings.
Which is exactly why financial advisors constantly point people toward ETFs.
Yeah. And I always look at an ETF like buying a greatest hits compilation album.
Oh, I like that analogy.
Right, because if I bet my money on one single indie band and they break up, my investment is entirely wiped out. But if I buy an album featuring 50 different bands, I get exposure to the whole genre.
Yeah, if one band fails, the others just keep the album selling.
Exactly.
And that protection of diversification is the entire appeal here. With a technological shift as profound as artificial intelligence, nobody actually knows where the most lucrative innovations will ultimately come from.
Right. Will the biggest profits be in the software, or the data centers, or maybe the physical robotics?
Nobody knows for sure. An ETF allows you to benefit from the industry's overall rising tide without needing to be a clairvoyant about every single corporate battle.
But that raises a pretty glaring question for me. Like, if I want to invest in, say, the airline industry, there are really only a handful of ways to do that.
Yeah.
But with artificial intelligence, there are dozens and dozens of different AI ETFs out there.
Yeah, there are a ton.
So if it's just one industry, Why are there so many different funds?
Well, the assumption there is that AI is a single industry, which is a massive misconception. It is a huge, multi-layered ecosystem.
Okay, how so?
What's fascinating here is that the best way to visualize it is to think of a human body.
A human body. Okay, I'm tracking.
Right. So you have companies building the physical robots, right? The mechanical arms assembling cars or sorting packages in a warehouse. Those are the hands and feet interacting with the physical world.
Makes sense.
Then you have companies manufacturing these semiconductor chips. Those chips are the brains, the central nervous system that's actually processing the signals.
Oh, I see where you're going with this.
And finally, you have the software companies creating the generative AI algorithms, which act as the personality, the actual thoughts.
So two funds could both have the letters AI slapped on their label, but hold completely different companies because they are targeting entirely different layers of that anatomy.
Precisely. Because AI touches literally everything from agricultural farming equipment to the smartphone in your pocket, these fund managers define AI in wildly different ways. You really have to know which layer of the ecosystem you are actually buying into.
All right, let's start with the physical layer then. The hands and the feet. The sources we're looking at highlight two massive heavyweights in the robotics and automation sector, ROBO and BOTZ.
Yes, the two big ones.
Now, on the surface, these sound like duplicates. They both focus on robotics. But the data shows they behave very differently. Why is that?
It comes down to their internal mechanics, specifically how they weigh the companies inside their baskets. Let's look at BOTZ first.
Okay, BOTZ.
Right. That is the Global X Robotics and Artificial Intelligence ETF. It's the cheaper one to own with an expense ratio of 0.68%.
Not bad.
Not bad at all. But it is highly concentrated. It only holds about 50 stocks, and it is market cap weighted.
Wait, if it's market cap weighted, that means the biggest companies by market value take up the most space in the fund, right? Aren't you basically just buying NVIDIA with extra steps then? Like, why pay an ETF fee if one or two giants are going to dictate the whole fund's performance anyway?
Well, you've just hit on the primary criticism of market cap weighted thematic funds. The giants completely dominate the performance.
Right.
In BOTZ, a massive company like NVIDIA, along with these massive Japanese automation titans like FANUC and Keyence, they make up a huge chunk of the portfolio.
How huge?
Its top 5 holdings alone account for almost 40% of the entire fund.
Wow. Okay, that is top heavy.
It is. The upside is that when those massive companies have a great year, BOTZ just skyrockets. But the downside is that if just 2 of those companies face, say, a supply chain crisis, the entire ETF plummets, regardless of how the other 48 companies are doing.
Which seems to totally defeat the purpose of that greatest hits diversification we just talked about.
It definitely dilutes it.
So how does the other one, ROBO, solve that?
ROBO Global Robotics and Automation Index ETF takes a completely different mechanical approach. It is more expensive to own at a 0.95% expense ratio.
A bit pricier, yeah.
But it is incredibly diversified. It holds around 87 stocks, and it uses a tiered equal weight approach. The rules of the fund basically dictate that none of the individual stocks can account for more than 2.5% of the fund's total value.
Explain the mechanism there, because equal weighting always sounds great in theory, but how does it actually work in a market where stock prices are constantly changing every second?
Right. It forces a discipline called rebalancing. Let's say one of the small robotics companies in the Robo Fund has an incredible quarter. Their stock price doubles.
Great for them.
Exactly. But suddenly they make up 4% of the ETF's value, which violates that 2.5% rule.
Oh, I see.
So the fund manager is mechanically forced to sell off that extra 1.5% of the winning stock and use that cash to buy more shares of the companies in the basket that have actually dropped in price.
Oh, that's brilliant. It essentially automates the hardest psychological rule in investing, which is to buy low and sell high.
It does. It removes the emotion.
It forces you to take profits from your winners and reinvest in the underdogs.
Exactly. And that mechanism is why Robo is able to push way down into the small and mid-cap companies. Because it doesn't let the giants dominate. You get exposure to names you've probably never even heard of, like Teradyne or Co-Young Technology.
Definitely haven't heard of those.
Most people haven't. It's what analysts call a pure play on the space. It focuses on smaller companies that get their actual core revenue directly from building factory automation, rather than just some trillion-dollar tech company that happens to have a side AI division.
Let's bring this back to our $45,000 Tesla scenario, just to see what this mechanical difference actually yields.
Good idea.
So if you take that cash and put it in a standard high-yield savings account earning around, say, 4 or 5%, it's going to take you over 20 years to generate enough profit to buy the car.
2 decades of waiting.
Right? Nobody wants to wait that long.
Yeah.
But if we look at Robo's historical performance, its compound annual growth rate, or KGR, sits at around 13.1%.
That's a solid number.
Yeah. And at that pace, your original money stays untouched, and the gains alone could hypothetically generate the purchase price of that Tesla in about 7.5 years.
Which is a pretty dramatic improvement over 20 years.
Huge.
It really shows the power of compounding in a growing sector. But we do have to acknowledge that Robo is focusing on factories, supply chains, and industrial robotics.
The hands and feet.
Exactly. It's the practical blue-collar side of AI, and that requires physical parts, shipping, raw materials. Because of that real-world friction, it's steady, but it's not the fastest-growing part of the market.
Okay, so if physical friction slows things down, what happens when we remove it entirely? Let's move to the software, the data, the pure tech powering the digital side, the brains and the personality of our anatomy analogy.
Right. When you move to the digital layer, you start looking at broader tech ETFs. And this is where the stock picking methodologies, the rigid rules these passive funds follow to choose what actually goes into their basket, they get highly specific.
And sometimes a little bizarre from what I read in the sources.
Yeah, absolutely.
Let's look at AIQ first, the Global X Artificial Intelligence and Technology ETF. This thing is a behemoth with almost $8 billion in assets. It holds 85 stocks. But unlike Robo's obscure factory builders, these are like household names. Apple, Cisco, Samsung, Netflix.
Right, because AIQ's methodology captures the companies that are actively using AI to hyperscale their existing digital businesses.
Okay.
Think about a company like Netflix. They use machine learning to keep you glued to your screen with hyper-personalized recommendations. Because AIQ leans into these massive proven tech platforms, its historical compound annual growth rate is around 20.4%.
Wow.
Yeah, it has significantly outperformed the broader market.
And at a 20.4% growth rate, our $45,000 Tesla timeline shrinks from 7.5 years down to just under 5 years.
Not bad at all.
Not bad.
Yeah.
But what if I don't want the giant platforms? Like, what if I want the smaller software companies building the next big data breakthrough?
Then you'd look at RD, the iShares Future AI and Tech ETF. It's actually the cheapest option we're looking at today, with a 0.47% expense ratio.
Okay, level low fee.
Its methodology actually prefers weighting smaller cap companies over the large ones, and it focuses heavily on big data and machine learning.
The sources did flag a warning on RD, though. They mentioned the trading spreads can be slightly wider. For the listener who just wants to, click buy on their brokerage app, why does the spread even matter?
That's a great question. The spread is basically the gap between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept at any given millisecond.
Right.
When you deal with massive companies like Apple, millions of shares trade every single minute. The spread is literally a fraction of a penny.
Super efficient.
Exactly. But because RD holds smaller, more obscure companies, there is less liquidity. Fewer people are trading them. So the person selling might demand a slight premium, and the buyer wants a discount.
I get it.
That wider gap means when you buy RD, you might lose a tiny fraction of a percent of your capital just to the inefficiency of the transaction itself.
It's like a hidden cost of trading small cap stocks. Good to know. But if we're talking about fascinating methodologies, we have to talk about ROBT, the first Trust NASDAQ Artificial Intelligence and Robotics ETF.
Oh, this one is interesting.
Right. They don't just buy AI companies. They categorize them into a highly specific class system.
They do. They screen the global market and mandate that every single company must fall into one of 3 buckets: engagers, enablers, and enhancers.
Okay, let's test this. If I look at a massive agricultural company like John Deere, they make tractors, obviously, but now they're outfitting those tractors with AI vision systems to spray pesticide only on weeds and avoid the crops. Are they an AI stock? Where do they fit?
So under ROBT's methodology, John Deere would likely be classified as an enhancer.
An enhancer. Okay, because their core business is an AI.
Exactly. They are fundamentally an agriculture equipment company, but they are heavily integrating AI to enhance their own existing products and services.
Okay, so what makes an engager or an enabler then?
Well, an engager is a company building the core foundational technology. Think of a semiconductor company designing the actual architecture of the neural network chips. They are engaging directly in the creation of AI.
Got it. And enablers.
An enabler is a company creating the advanced machinery or the data delivery systems that allow that core tech to function.
Okay, that makes sense.
ROBT weights the fund based on these specific roles, ensuring you aren't just buying a bunch of tech giants, but a structured cross-section of the entire ecosystem.
Okay, here's my problem with all of these passive ETFs, though.
Let's hear it.
I look at these complex, rigid rules, and I can't help but think about buying a pre-packaged salad at the grocery store.
A salad.
Yeah, like you trust the label that says spring mix, but you don't actually get to pick the specific tomatoes or the lettuce in there. And the real danger is that the rules dictate what's in the box, and it's completely static until the fund officially rebalances at the end of the quarter.
You're hitting on the fundamental flaw of passive investing right there.
Right. If the tomatoes go bad on Tuesday, the fund manager cannot remove them until the quarterly rebalance on Friday. You are contractually forced to hold rotting assets.
Yeah.
And in a sector moving as violently fast as artificial intelligence, where a new algorithm can render a competitor obsolete overnight, waiting 3 months to adjust your portfolio seems incredibly dangerous. How are investors capturing the real-time, bleeding-edge speed of this market?
Well, to capture that speed, you really have to abandon the broad digital umbrellas and look at the most aggressive, concentrated options available. And you cannot talk about raw speed without talking about the physical backbone of all this computation, which is semiconductors.
Because none of the software, none of the generative AI chatbots exist without the specialized chips required to process billions of parameters a second.
Exactly. The hardware is the bottleneck for the entire industry. That is why an ETF like SMH, which strips away the software and the robots and focuses purely on the semiconductor industry, boasts a 28.5% historical compound annual growth rate.
Oh, at that blistering speed, our Tesla goal shrinks down to just 3.5 years.
Or you could look at ARKQ, which is a fund focused purely on deep disruption autonomous vehicles, next-generation energy storage.
More futuristic stuff.
Yeah, that fund leans into experimental technologies early before they are fully mainstream. It holds a 32.9% historical growth rate, pushing the timeline down to 3 years flat.
But those are still traditional, human-managed or rules-based funds. Here's where this deep dive gets really interesting.
Oh, I know where you're going with this.
What if we step away from human fund managers entirely? Enter the Roundhill Generative AI ETF, ticker symbol, CHAT.
Chat is a completely different animal. It is actively managed, but not in the traditional sense.
Right.
You don't just have a room full of Ivy League financial analysts passively holding stocks. You actually have artificial intelligence itself constantly adjusting the portfolio based on real-time developments in the generative AI space.
I want to make sure I understand the mechanics of this, because it honestly sounds like science fiction. They are literally using artificial intelligence to pick AI stocks.
Yes, they are.
How does the algorithm actually choose what to buy? Like, what is it looking at?
It uses natural language processing to read through the quarterly earnings transcripts and the dense 10K financial filings of thousands of companies.
Oh, wow.
Yeah, these are massive, incredibly dry documents that would take human analysts weeks to comb through. The AI scans them in seconds, scoring companies based on how frequently and how substantively the executives are discussing terms like machine learning, large language models, or generative AI.
So it's looking for companies that are actually putting their money where their mouth is regarding AI development. It's basically replacing the Wall Street analyst.
It's removing the human emotional bias. I mean, a human analyst might hold on to a failing stock because they really like the charismatic CEO, or they have a gut feeling a turnaround is coming.
Humans are flawed like that.
Exactly. The AI algorithm doesn't care about charisma. It only cares about the data. The companies with the highest keyword density and substantive AI revenue metrics get the highest weightings in the portfolio.
And because of that active, emotionless management, it holds massive, highly concentrated positions in undeniable current winners like NVIDIA and Palantir. The results are frankly shocking.
They really are.
Since its inception in 2023, Chet boasts a staggering 36.8% compound annual growth rate. If you apply that math to our original scenario, that $45,000 Tesla timeline gets cut from 20 years in a savings account down to just 2 years and 8 months.
The mathematical difference between a 5% yield and a 36% yield fundamentally alters the trajectory of your financial life.
Hold on, though. We have to inject some reality here. A 36% return doesn't just happen by magic. That implies massive stomach-churning volatility.
Absolutely.
If I'm putting my $45,000 into a highly concentrated fund picked by an algorithm, what happens when the AI gets it wrong? Or what happens when the entire generative AI sector hits a regulatory roadblock? I'm going to wake up to my Tesla fund being cut in half.
That is the exact risk you assume with hyperconcentration. Chat is not trying to own the whole market. It is trying to own the absolute sharpest edge of the spear.
Right.
And if the spear breaks, you feel the entire impact. High reward is always tethered to high risk.
So what does this all mean for the person listening to this right now? With all this data, the differing mechanics, the varying timelines and risk profiles, how do you actually figure out which strategy is right for your own money?
It all comes down to profiling yourself as an investor. You have to strip away the hype and be brutally honest about your own psychological risk tolerance.
Okay, break that down for us.
Well, based on the sources, we can synthesize the options into a few distinct profiles. First, you have the conservative believer.
Oh, this is the person who knows AI is the future, but they don't want to check their brokerage app every morning and have a literal heart attack.
Exactly. If you want to sleep soundly, you need broad, predictable exposure to the long-term trend. Funds like AIQ or ROBO are your best bets.
Because they're more grounded.
Right. They are grounded in real-world infrastructure factories, supply chains, and massive tech platforms that are already highly profitable. They won't give you whiplash, but they will give you steady exposure to the upside.
Then you have the aggressive conviction investor.
Yeah, this is the investor who looks at generative AI and says, this is a once-in-a-generation shift, like the invention of the internet, and I want maximum velocity.
Give me the speed.
Right. If you can stomach the volatility and want active management that can pivot in real time as new leaders emerge, Chad is the clear vehicle. Despite its short track record, it is built for speed.
But we also have to include a crucial counter perspective from the research here. Because not everyone is sold on the idea of a hyper-specific thematic ETF. What about the broad market skeptic?
This is a really vital viewpoint. For some financial advisors, thematic ETFs, even the diversified ones, are simply too vulnerable to a single sector's narrative.
Sure.
If the AI hype bubble bursts or if regulation severely handicaps the technology, all of these specific funds will plummet. The alternative strategy is simply buying the NASDAQ Q100 through a broad, cheap ETF like QQQM.
Because the reality is the NASDAQ Q100 is already dominated by the tech giants driving AI anyway.
Precisely. By buying a broad NASDAQ Q index, you still get massive exposure to the AI revolution through companies like Microsoft, Google, Meta, and NVIDIA.
But with the safety net.
Yes. Crucially, you also have the safety net of a broader market index that includes other sectors like retail and healthcare to cushion the blow if tech stumbles. It's a way to capture the upside without entirely betting the farm on a single theme.
It really brings us back to where we started. That $45,000 sitting in the checking account, slowly losing its purchasing power to inflation, just waiting for a decision.
Yeah, it's a tough spot to be in.
The ultimate takeaway from peeling back the layers of all these funds is that how you position your money mechanically dictates how hard it works for you. You don't have to pick the winning horse. You don't have to stay up until 3 a.m. reading semiconductor supply chain reports or trying to outsmart a Wall Street algorithm.
Thank goodness.
Right. You just have to pick the right stable that matches your timeline and your stomach for risk.
If we connect all these mechanics to the bigger picture, we have spent this entire deep dive talking about using artificial intelligence as a financial tool, a way to generate wealth, to shorten timelines, to buy physical things like cars without depleting your hard-earned savings.
All right, we're talking about using the tool to essentially hack the traditional slow financial timeline.
But here's the thought I want to leave you with. We are currently measuring AI's value using the old metrics of money and labor.
Okay.
But if artificial intelligence truly adds $15 trillion to the global economy by the end of the decade, by fully automating factories, writing its own code, and fundamentally doing the intellectual and physical work of human beings, will it just change how we invest our dollars?
Right.
Or will it become so efficient that it fundamentally rewrites what money, human labor, and value even mean in the future?
Man, if the AI is doing all the work, what is the currency of the human being even worth? Something to mull over the next time you look at your bank account. Until next time.